Hey Bowtie Nation, Joseph Hogue back with one of investors' toughest questions right now. With stocks so expensive, what do you buy? And it's not just stock prices, but as the bull market has run higher, dividend yields have plunged. Because remember, the dividend yield you collect is the dividend amount divided by the price you paid for the stock. Last year, you could have bought shares of the S&P 500, the stock market index, for $437 each, and the fund paid a quarterly dividend of $1.91, or $7.64 a year. That is a 1.75% dividend yield. Not super high, but not bad for an index fund. But the stock market has surged 38% since then, while dividends have actually decreased. The fund recently paid a $1.75 per share dividend, just $7 annualized, and that lower dividend divided by the higher price means you're only collecting a 1.2% yield. Even some of our favorite dividend funds have felt the sting. With its 42 cents per share quarterly dividend last December, the Fidelity High Dividend ETF, the FDVV, was actually paying a high dividend at 4.3% yield. Now, not only has the price gone crazy, but the dividend is down, and this high dividend is putting less than 2.8% in your pocket each year. So at these prices, you need to be extremely selective of your dividend stocks you buy, and in fact, I'm only buying one new dividend stock this month. I'm going to highlight the 4 stocks that almost made the list, 4 dividend stocks worth watching, and what I'm looking for to buy them fast. Then I'll reveal that one dividend stock, the only one that is a screaming buy right now. Let's get started with one I highlighted recently in another video, one of my favorite real estate stocks, WP Carey, ticker WPC, with its 5.9% dividend yield. Like a few of these other dividend stocks I'm watching, I already own shares of WPC and like it for that long-term, high-yielding stock, but there are a few reasons I'm holding off on buying more shares right now. WPC is a $13 billion real estate investment trust with almost 1,300 properties across 170 million square feet. And the reason this makes so many of the lists is its diversification. First, the company's real estate is spread across multiple property types. About a third of the rent comes from industrial properties, with another third from warehouses, but then you've also got 21% from retail and another 15% from other types, so crisis in any one property type isn't going to kill the company. WPC is also the most geographically diversified REIT I've seen, with a full third of the rents coming from properties in Europe to smooth out that focus on US real estate. And so it's that diversification across property type and location that makes WPC one of my favorite REITs, really reducing your risk in real estate, but keeping the high cash flow potential. But then if we look at the fundamentals for the company, especially those around the funds from operations, and remember that FFO is what you need to be following here with real estate stocks because it backs out that massive depreciation expense that skews earnings. But if we look here at the NAREIT REITwatch monthly report, we see WPC is only expected to grow its FFO by 1.9% over the next year. Now that's above the average for its group, but is still anemic growth. The company is already paying out 62% of its FFO to cover the dividend, below the average for its group also, which is good, but still doesn't leave a lot of room for if it's not growing that FFO. So at a price of 12 times its FFO, the stock here isn't necessarily a steal, and the FFO isn't going anywhere fast. I've been heavily investing in real estate stocks over the last year ahead of the Fed rate cuts, and do think those lower rates start supporting the group higher. This is one though where you could start a position at this point and be very happy long term, but I'm waiting to add more shares. We'll get back to our dividend stocks list, but first, I found an investment that beats them all with a 7% yield on Worthy Bonds, a fixed income platform with bonds backed by small business and short-term real estate loans. You can invest as little as $10 per bond and earn interest on a daily basis. Best of all, you can withdraw all or some of your money anytime with no fees or penalties. Worthy even has a roundup feature that lets you invest your spare change on purchases into bonds, automatically building your portfolio. I'll leave a link in the description to more information. These are great supplements to your dividends, providing a higher yield than most stocks. Use that link below and you'll get an exclusive deal I worked out for everyone in the Bowtie Nation. Buy 5 bonds and get 1 free. Invest just $50 and get $10 free. That is a 20% return on top of the 7% interest rate. So look for that link below or just scan the QR code here. Back to our dividend list and one of the best returns in my portfolio, NRG Energy, ticker NRG. But at a 1.9% dividend, it has outrun its yield. Now, I recommended NRG as my favorite utility stock last year at $34 a share and a solid 4% yield. The stock price has since jumped 150%, but the dividend has just not kept up, even after an 8% increase in the payout. This company is one of the largest energy producers in the United States with over 6 million residential customers and 14 gigawatts of generation across electricity and natural gas. And what we've seen in utility stocks we've talked about on the channel, As an independent provider, Energy has it both ways, the protection that comes from a regulated market, but also the leeway to sell its excess generation at higher rates. It's been able to take advantage of that this year as big tech companies scramble to find electricity for the data center boom. The company already had an aggressive development plan with 21 sites lined up and should be able to contract out that capacity, but utilities might have gotten ahead of themselves and are now trading very expensively. Shares are now trading at almost 13 times expected earnings, twice the valuation they were at last year, and for dividend investors, that 1.9% yield just isn't going to cut it. What I'm afraid of here, what I'm waiting for, is for local governments to see that boom in electricity demand and want a slice of the pie, increasing their control over even these independent producers. That headline risk and overbought valuations have me taking a pass on some of these utility names right now. Diamondback Energy, ticker FANG, is another one we've highlighted recently, and it is hard not to keep loading up on this 6% dividend. Diamondback and other energy stocks have banked on record U.S. production over the last 5 years, and no other area has benefited as much as the Permian Basin, where the company has its assets. Despite a slowing economy, dual conflicts in Ukraine and Israel have kept oil prices higher, and that's contributing to these higher earnings. Diamondback expects to turn just 3% growth in oil production into a big earnings jump and 7% increase in base dividend. The company booked 50% earnings growth and 25% revenue growth over the year to its last quarter. That's not likely to repeat, but Diamondback has a history of getting the most out of its spending. This bottom chart here shows the company gets 41 times its capital spending in oil production, well above the other companies in its industry. That is the kind of efficiency that is going to continue to generate that cash flow and is going to grow the dividend. Topping it off, shares trade for just 9.4 times on a price to earnings basis, and anytime you can get a stock growing like this for under 10 times PE, it is always something to consider. The only thing that worries me right now with adding more is the price of oil is a big question mark right now. Oil is traded in a range of $70 to $80 a barrel for the better part of 2 years on those dual conflicts in Ukraine and more recently in Israel. Any de-escalation there or a recession in the United States could see oil drop below $65 a barrel fast, or conversely, we could just as easily see a spike past 90 if Iran gets further drawn into the conflict. So while I like the company and most drillers are deeply cash flow positive, I don't like having my money depending on events that I just have no way of forecasting. You've probably got a sense of what I'm looking for and why I'm watching these stocks and not buying all of them just yet, but I want to highlight a few ideas here. First and most obvious, I'm looking for dividend stocks that actually pay a decent dividend. That average 1.2% yield on the broader market isn't going to pay my bills, and a lot of the dividend stocks have just outrun their yields this year. So I'm looking for dividend yields above 3%, but if it's only because the stock price has plunged, then you have to be extremely careful. Another stock I'm watching, FMC, is paying a healthy 3.7% dividend, but partly because the price has halved in the last year. It's basically the opposite of what we're seeing in the market. Here, a lower stock price and a stable dividend, meaning that yield has increased. But then it doesn't mean that you rush into these higher yield, falling price stocks. First, I try to understand why the stock price is falling. Is it an industry-wide problem or just something specifically wrong with the company? If it's that bigger picture that's holding it back rather than bad management, then I'll look into the business and its fundamentals. Does it have a leadership position or advantages so when the industry does bounce back, then it will outperform? If all of this points to a quality company, then I look for the catalysts. What headlines or trends could be coming to push the stock higher or lower? Is there anything to turn the industry trend around, or could it get worse? So what's the timeline for any of those catalysts, and what do I need to be watching for as a signal to start buying those shares? And I know, folks, this is a hell of a lot more work than just buying the cheapest stocks or the ones with the highest dividend yields, but it is the only way you can have the confidence that you're buying quality companies at the right time and at the right price. Back to our list of dividend stocks I'm watching, and that FMC Corporation, ticker FMC, with its 3.7% yield, was the worst performing stock in the S&P index last year. FMC is a leader in crop health and protection to help farmers get more out of each acreage, and has a diversified business across every continent, with $4.5 billion in sales. With arable land decreasing and the world food demand increasing, the only way you meet those targets for world food production is by getting more out of where we grow, and that means agrochemical producers like FMC are in a very good long-term picture. But the agricultural market is one of the most cyclical out there, regularly going through those booms and busts every 5 to 7 years. And here every cycle is the same. Profits and growth lead to oversupply and plunging margins, but that long-term demand growth remains and pulls the industry back into an uptrend. In fact, if you had invested at the trough of the previous correction in 2015, you would have seen shares triple to 2022 for a 23% annual return plus the dividend. And shares here look like a great deal with that price to earnings less than a third of where it was trading last year, and that 3.7% dividend isn't bad either. But the ag industry could go from bad to worst very soon. That's because if we get the kind of tariffs on Chinese products that are being talked about, there's one way China knows how to retaliate, and that's through its crop imports. China is by far the largest importer of U.S. crops, buying a record $35 billion in 2022 and accounting for half of our soybeans exports, a quarter of our corn, and almost all of sorghum exports. So a China retaliation would be the final straw to the ag market and would see FMC drop lower, but again, the company is a critical piece of the industry and has that long-term demand upside, so I'd be buying if it fell back maybe into the lower 50s or 40s on that long-term theme. Next, I'll reveal that one dividend stock I'm buying right now, the one with the fundamentals pointing to the upside return even in this market. But these aren't the only dividend stocks I'm watching. You know we love us some SCHD dividend ETF here on the channel, but I just uncovered 5 stocks that beat the fund with a higher yield and a stronger upside. Make sure you watch this video next to see those stocks. But the one dividend stock I am buying right now, Ally Financial, ticker ALLY, with its 3.5% yield and a terrific value. Shares of the online bank plunged 17% on its last earnings call, despite beating those earnings forecasts by 79%. In fact, the company has been progressively beating earnings expectations over the past 3 quarters. What Wall Street didn't like, though, was the weakening in those consumer loans, especially the auto segment. Auto loan charge-offs, the percentage of loans the company believes it's not going to get paid back on, are now expected as high as 2.3% versus a previous estimate of 2.1%. And Ally put another $645 million into its loan provisions, that cash account used to offset bad loans. Total auto lending of $9.4 billion also came $1 billion short of estimates as the company tightens its loan standards to avoid more defaults. So management is clearly signaling that a storm is coming and that it's hunkered down for the next few quarters. But Ally is a solid fintech, and while auto lending is still its bread and butter, it's also the largest digital bank with a growing business in insurance, credit cards, and home loans. Now, all you out there in the nation know SoFi Technologies is my go-to fintech with over 25,000 shares and a $100,000 profit, but the 43% surge in the stock has made it pricey at about 1.9 times on its price-to-book valuation. Compare that to shares of Ally, now trading for just 0.85 times on a price-to-book value after the drop, a ridiculously cheap value for growth that it should see when the lending rebounds. And if all that wasn't enough, the bank has a vote of confidence from the Oracle himself, Warren Buffett. Buffett's Berkshire Hathaway portfolio owns 29 million shares of Ally, and while it's not a big part of his overall portfolio, it does give him 9.5% of all outstanding Ally shares. Get your free bond and a 7% yield with the exclusive invite offer to Worthy Bonds with the link in the description. Or click on the video to the right to see those stocks that beat one of my favorite dividend ETFs, the SCHD. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.